Good afternoon, everyone. I hope you enjoyed your lunch. I don't have to tell the crowd here, but obviously a very exciting time for crypto and for tokenization. It seems every day we're getting a new news event that makes a week seem like a month, so a lot to talk about today. I did want to start with something topical that I thought could be fun to start the discussion, ease us into tokenization. We saw Trump obviously sign the executive order, do a lot of actions that are bullish on crypto. He also launched this meme coin, I think to the surprise of pretty much everyone in the industry. I'm curious, for your perspective, is the Trump and Melania meme coin bad for crypto?
So I'll probably focus on the positive elements. So it's very cool to see a chain get battle tested with 3 to 4 million users trading on decentralized exchanges over a weekend. It also drove a lot of net new investors to the blockchain, helped them onboard, get wallets. And so from that perspective, I think it's a net positive. I'll reserve judgment on kind of the other aspects of it, but super interesting to see, nonetheless.
I think it's really moved the overtone window in the sense that, so haven't talked about who we are yet, but my name is Shaul, I'm from Digital Asset, and we work a lot with regulated financial institutions. And over the last few years, we've seen a lot of, I'll say, trepidation and kind of tiptoeing very, very carefully around regulation and a lot of uncertainty around regulation. And I don't have any opinion about the coin itself and it took me by surprise as well. But I think it was a very clear shift in narrative saying, okay, there's something completely different here. And maybe pushing to a direction of you can be more comfortable about the level of experimentation and the level of things you can do now. So I think it was just kind of setting the tone for what we should expect from the next administration in terms of what you can do, what's considered legitimate. Now, it's taken it to the extreme of legitimacy of what would have been perceived as legitimate just a month ago. But I think that's very positive for us as an industry.
I think I agree with Max that meme coins have a role to play, right? I think over the last, 4 years, 5 years, we have seen meme stocks. So it's brought a new generation of investors into the market. Now, whether it's positive or negative, I can't say for it, but it brings in activity, and I think that's a trigger, and that through activity, access, and hopefully, like Shaul mentioned, people are getting more comfortable with the new world of permissionless blockchains.
The reason I wanted to start with that is I feel like when we talk about real-world use cases, the challenge is almost always establishing the legitimacy of crypto, and I think that becomes even more apparent with tokenization, which is obviously trying to basically reshape the plumbing of the financial system. And I know for many in this room, you're at traditional financial institutions, you probably have small teams or pilots that are exploring this, but at the same time, you have to convince your colleagues that this is an industry to be taken seriously. And I feel like whenever you have something like Fartcoin dominating the discourse, it might be harder to have those discussions with your colleagues. So I'm curious, and Max, maybe we can start with you, being from Blackrock. What do you think right now are the main blocks to tokenization? When you try and speak with your TradFi counterparts and get this across, what's your pitch for what tokenization can really do to improve the financial system?
So the benefits of tokenization people have kind of talked about probably since 2015, maybe earlier, right? Transferability almost instantly, the ability to program them into smart contracts. That's all very interesting. And the challenge, though, is how do we go from those promises to getting real-world adoption? One approach we took was let's meet the participants where they are. A lot of focus has been on bringing tokenization to traditional financial institutions. But one challenge today is that from an infrastructure perspective, their traditional custodian might not be able to support a tokenized asset, or their prime brokers might not accept it, might not accept lending against that tokenized asset. So it's a real friction from an adoption standpoint on the TradFi side. And so our kind of approach this time around was let's kind of see the people who already have wallets, who already lend against crypto assets, can interact with them. And actually start to show real utility with the sort of idea that over time, our traditional financial institutions and counterparts will slowly but surely get more comfortable interacting with these public networks or offering, their traditional custody services around public blockchains. And rather than wait for that to happen, starting with the kind of crypto asset native ecosystem and sort of proving it out, building the liquidity, connectivity, showing the different use cases, what you can do beyond just holding a tokenized asset, but really putting it into DeFi. That's kind of the approach we've sort of taken for now.
Shaul, do you have any thoughts on that? Because I know you're also working with a lot of institutions to try and get adoption. What do you see as the main blocks? Or I know we talk a lot about what the utility of is tokenization, but moving beyond just a pilot program to them to actually start really using it in a substantial way. What's the pitch there?
Yeah, to me, first of all, I'm seeing the trend is a great kind of convergence at last between what used to be two separate things. There was the crypto asset class, and there was the discussion about blockchain as a technology for traditional real-world assets. And in the last year or so, we've really started seeing that convergence if it's money market funds issued on public chains. But also we're seeing the crypto players need regular high-quality collateral to meet their margin requirements. And on the other side, we're seeing large institutions, Broadridge doing repo transactions. So we're seeing this convergence. I think still the biggest blocker by far is it's a bit nuanced, but it's privacy on public chains, and I'd say it's the mix between privacy and integrity. And privacy is something that's absolutely critical for adoption of tokenized financial assets. But I don't think there's enough understanding in the industry of the trade-offs of certain solutions. So the biggest example I have is zero-knowledge proofs, which I still think a bit of magical thinking that this kind of crypto black box is going to solve our privacy problems. But we also need to think about the failure modes and think, for those who aren't familiar, zero-knowledge proofs are an amazing technology that allows me to say something to the tune of, I have now locked some amount of high-quality liquid assets to meet my margin requirements without disclosing anything on the public chain about how much I've locked and what are my margin requirements. So it's kind of this, in theory, perfect privacy solution with no limitations. But in practice, we have to think about failure modes of integrity, of things like, okay, and now if there is a software bug in the implementation of a zero-knowledge proof, then does that undermine the trust in this whole system? So I think finding that right balance of layered solutions that bring in the right level of privacy on top of public blockchains, I think that is the most critical unlock that we're going to see over the next year or two that really enable traditional finance to move into public blockchains and start moving assets in full volume on public blockchains.
Prakash, do you see this moving outside of crypto to where you start to see traditional financial players using different tokenized programs in a way that's not necessarily crypto native?
Yeah, for sure. I think if you look at what we are doing, right, and a quick introduction, I'm part of Broadridge, which is an infrastructure provider in the financial markets globally. As you mentioned, Shaul mentioned that actually that we launched a repo solution on blockchain a few years back now. We've been live for 3-4 years now, and it's been growing in volumes. It today runs actually on a private chain, but the idea is actually that we will grow into accepting. Repo is about collateral securities financing, right? And so use of collateral could be from anywhere. Today we tokenize actually treasuries and move them digitally. So there is real value that these institutions see in efficient movement actually without kind of worrying about depository locations of these assets. And I think that's the big value. And there's a huge cost saving because of that. New products being created actually, intraday repos, I don't think would have been feasible without this technology, right? So I think that's the path, I think, that we see, that there is a real use. If there is a real use and there is value to be delivered, obviously there will be the token. The tokens have to be useful for some activity. And I think one activity which has been the low-hanging fruit is in collateralized transactions. I think that's been the default. Whether it's used actually in the crypto world in some fashion, or actually in the TradeFi world, it is actually the most efficient way of actually delivering and moving collateral. I think we see that as the primary driver for many of the use cases, and then more building blocks on top of that, more contracts, etc.
The decision makers, at financial institutions are a generation that has grown into these markets, and kind of we're used to the retail experience where you can move anything 24/7. That still doesn't exist in most kind of traditional collateral markets, and we're also seeing, I think the fastest pickup is on that area of tokenizing collateral, and then tokenizing any kinds of assets where you want to do collateralized trades against those assets.
So let's continue on that vein, because the topic of the panel is real-world use cases. I mean, I think Blackrock and Broadridge are probably somewhat unique in the world of traditional finance in that you have real dedicated digital asset teams that aren't just doing it to pay lip service. You're actually adopting these tools that you're building or using. But it still seems to me, and correct me if I'm wrong, a tool like BUIDL is still mostly going to be used by companies that are already comfortable in the crypto space. So what are those use cases that you think are really going to first break through into the mainstream? I know stablecoins are brought up a lot, and it does seem like with companies like Bridge and BVNK, you're starting to see stablecoins being used by non-crypto companies for things like global payroll. What other examples like that do you see out there, do you foresee as being those real breakthrough use cases when it comes to tokenization? And Max, maybe we can start with you.
My guess would be this adoption is going to start with sort of these hybrid firms. So there's a growing number of very traditional hedge funds, asset managers, investors who have started to venture a little bit into crypto, whether it's offering ETF products or creating crypto hedge funds. I think they're going to be the sort of natural first kind of movers here, where they have real utility, right? Maybe if it's just, can we start to earn yield on the collateral that we post? Can we get lower haircuts? Can we reduce our counterparty risk? And once they start getting comfortable and really realizing that utility through their sort of crypto arms, I think that's when it's going to start to spread to other parts of their business. But it will require the acceptance of those assets from their traditional counterparties. And it seems like now, especially with SAB 121 getting repealed yesterday, that a lot of the barriers that have prevented traditional institutions from interacting here will start to come down. It'll reduce the friction, and the less friction you have, the less of a need to see a sort of 10x improvement in order to justify the adoption.
So I think Max made an interesting point earlier, actually, about institutions, custodians, and infrastructure supporting it. I think that's a very critical piece, right, for any of this adoption. So if you look at it, right, so we collateralized, we are viewing collateralized trades actually as a potential biggest mover in the learning adoption curve. And I don't think we need new regulations or anything like that for that. I think the CFTC working group mentioned actually that any eligible collateral which can, under current laws, could be tokenized, right? If it is tokenized, then obviously, if it is, so the biggest use case would be that if eligible collateral is tokenized, then adoption actually will increase dramatically, right? And I think that can drive other assets. I think there has always been use cases talked about actually saying there will be new class of products which will be available for a larger market, etc. Those are all to be tested and validated yet, right? But this is existing value which can be leveraged more.
Yeah, we're seeing all type of financial assets now being tokenized. I think there are no kind of large regulatory barriers left, and this is predating the current administration. I mean, already, a year ago, we haven't really seen objections. There's been, again, trepidation, but not objections on regulatory basis with the existing regulation to tokenizing assets. We're seeing everything from fixed income, private equity, corporate fixed income, mortgages, even things like life insurance policies, everything being tokenized under the understanding that the rails are there, and you can start getting more liquidity and more utility out of these assets. So we're seeing a very large wave of things coming.
I feel like there's a spectrum of the bullishness that people feel in this area on tokenization, whether you're going to start just seeing more niche use cases where traditional assets will be tokenized, or whether it is going to fundamentally alter the plumbing of the financial system, whether every IPO will be issued on the blockchain in the future. I'm curious from each of you, where do you fall on that spectrum? Do you think in 20, 30, or 10 years, blockchain is going to underpin everything, or is it going to be more specific?
So in the next 5 years, I would say this evolution in tokenized asset, it's going to likely occur on the outskirts, right, on these public networks with these sort of hybrid use cases, and more is going to shift towards that. Hard to say if the whole plumbing in the next 5 years will be replaced. I would say I'm bearish on that. Maybe in the next 10 or 15 years, that might be more likely. But it's going to be a bit of a journey to get there and completely alter and adjust the financial system.
Yeah, I agree. I don't think every product needs to be on the blockchain. That may not necessarily fall on that. Originally, when we started this whole path, right, and all of us have been in this path for many years now, right? We thought that complex processes which have not been automated would be a good starting point. But that was not true, actually. It was very, very difficult to do those automations at all. And that's why they didn't happen, right? And so I think streamlining kind of standardized products was the path. I think areas where there are standardized products which are still inefficient would be like bonds, etc., would be the areas where actually there'll be adoption across in the next 5 to 10 years, right? Equities, we're talking about stocks. I don't know whether the whole financial markets, payments would all be actually hopefully on blockchains in the next 10 years. But whether all assets will be on blockchain, we don't know. But it might force the issue in 20 years that you cannot be a hybrid model. You have to be on the blockchain to gain the efficiencies of modern payment systems.
Yeah, I think 10 years is a blink of an eye when you're talking about financial infrastructure. I don't think these very, very large organizations and risk averse for good reasons will move everything to the blockchain in 10 years. But I think we'll see much more movement of assets. So we'll see the bridges that allow you to move between the traditional systems. A lot of banks are still running a huge amount of COBOL and Fortran, and that's fine, it works. But I think we'll see bridging of those things into networks. We'll definitely see more, we'll call it hybrid networks. I'll make a shameless plug here for Canton Network, which Digital Asset is one of the participants and behind the technology there, where we're seeing more and more customers come and say, we want to build things on private subnets, a bit similar to what Prakash said, Broadridge is building currently on a private network, under the understanding that kind of the first phase is you build things the way your organization already knows how to do and doesn't have the antibody reactions to doing it, and you build it using the technology that then allows you to connect into the public blockchains, but you have that on-ramp where you're starting with the private side of things, and the whole technology infrastructure is built such that you can connect into the public blockchain. And I'd say still a large portion of even our new customers are going that route, and I think that's the right route. But in 10 years, we will see all of those connecting to the public chain. So I think if I had to guess in 10 years, I think anything that's greenfield, probably 80% of things that are greenfield will be built on blockchain infrastructure natively. So not 100%, but it'll be a very large percentage. And then the things that are already running and running well and aren't built on blockchain infrastructure, and we'll just have the on-ramps, the way that the financial world knows how to do, segregating accounts and having sub-registers on a blockchain for a register that's on a traditional system. And I think we're going to see a lot of that still existing in 10 years from now.
So let's talk in the short term, and I think you all touched on this already, but say a year or two from now, again, when you're having these conversations with other people outside of the crypto industry, and you're trying to convince them to start adopting tokenization, what do you see as the biggest roadblocks right now? It seems like the past few years, obviously, it was regulatory uncertainty. Maybe that'll be unlocked now, maybe not, but what are the other big blocks? And Shaul, I think I know your answer already for what Canton is focused on, but what do you keep hearing in conversations?
Yeah, people come to us because of the privacy roadblock, and then I'd say when we see the roadblocks, it's more of the kind of the technical decisions within an organization. So some organizations say we have developers who know how to develop on this platform, and we want to continue that, and we don't want to learn a new platform for this thing. There's not enough ROI for this specific use case to learn a new platform. So we don't really see any roadblocks that are more fundamental than that about, regulation or it could be we've already chosen to use a different blockchain and we're going down that route. So we're already using, Solana or Ethereum or Besu or something like that. But we're not seeing any fundamental roadblocks that I can't do it because of X, Y, Z until you solve this problem. It's much more of the, either you do it on a blockchain or you don't, but it's usually not for reasons that are technical reasons not to do it on a blockchain. Sometimes it's not a good use case for a blockchain. Sometimes it's a use case where you're saying, hey, I have this retail product and I can build it as a SaaS. And, if you can build something as a SaaS and you don't need to interact with any other application or any other asset, then, don't overcomplicate it. Don't build it on a blockchain. But other than that, like for assets that need to interact with other applications, other institutions, other assets, it's not like it used to be 3 or 4 years ago. I'd say most of the use cases actually kind of go forward and get built.
I think to see really kind of real scale for these tokenized assets, and specifically tokenized securities, the big thing is the user onboarding, the friction, these whitelists. In traditional finance, you're able to leverage these KYC reliance agreements and tap into hundreds of thousands of investors, right, without having to re-onboard each one. And today, we don't really see that yet taking shape. It's that identity problem. And the cautious approach today is you do need to onboard every single investor. And that's why you see slower growth of tokenized securities versus tokenized cash, right? Stablecoins are able to grow and be integrated organically and rapidly. And I think a big part of that is the lack of that friction of everyone, if you want to interact, if the smart contract wants to interact with this tokenized asset, they first need to go through a big onboarding process. So to really scale that, I think we're going to likely need to see more of these sort of data sharing agreements or KYC reliance agreements with regulated players. So if you already have hundreds of thousands of users that have already been KYC'd, if another institution who's issuing a tokenized security can get comfortable with your KYC process, then maybe they don't actually need to re-KYC all their users and they can just sort of whitelist a third party's pre-vetted client base and their wallet addresses. And then these tokenized securities can start to feel a little bit more permissionless while still remaining compliant.
Yeah, I'd say that's actually a very good point. We see when people try to onboard to these, I'll call it composed application. So let's say you're trying to do a trade on one asset versus a money market fund and you want to have some lending solution in the middle. You need to go through KYC typically with 3 different vendors. And I agree, that is a huge friction that we're still seeing on the user onboarding side. And if someone can solve that, it's not a technical problem, it's a business problem. But I think if someone solves that, that will be a huge unlock for this space.
I think I have time for one more question, maybe 2. I did want to ask Max, and I'd love to get your perspective on this too. At Davos this week, Larry Fink, when the Blackrock CEO, when asked about tokenization, said that it could democratize investing. And I wasn't necessarily sure what that meant. And I'm always curious, especially with crypto, we've heard a lot about what this can do for savvy investors in the financial world, but I'm always curious how it trickles down to retail investors or everyday people. And I'm curious if you can unpack or maybe say what you think tokenization can do for the broader investing world.
Yeah, so from my perspective, when I think about democratizing access to financial products, a lot of that has been done, tokenization aside, with a lot of the rise of fintech applications over the last kind of 10 to 15 years. With tokenization, I think there's sort of 2 sort of kind of ways it could democratize access. There's the utility track, like what can you do with this token that it's very easy for me to buy or click. In 1 minute I own the IVV or S&P 500, and it works pretty well here in the U.S. But the utility of that is generally fairly limited as a regular retail investor. But perhaps if that asset was tokenized and you could easily, in 1 click borrow against it, or maybe put into a structured product protocol and de-risk or take the senior tranche. Like that is where I see a lot of those financial tools have obviously existed for traditional larger institutions for a very long time, but are generally less accessible to traditional retail investors. So that's kind of the utility track on the democratization of what you can do with the assets. And then I think, and this is less relevant for maybe the US, but globally, there isn't necessarily easy access in one click to buy and get exposure to these products. So that's really a story of bringing access to US's securities market potentially to a global investor base that otherwise might not have access to those products at lower fees too.
Any other quick thoughts on this one?
So I think democratization is a broad, is a word we overused actually quite a bit in the crypto world. But interestingly, last year there was a survey by FINRA about retail investors. And it looks like actually over the last 5 years, the younger generation which came into even stock trading came via crypto into stock. So they found the ease and access of crypto actually, and then they moved to actually other digital platforms, etc. And they stuck around actually in both, right? So there is a role for that. But one of the things they found out actually as part of that survey was that the financial literacy levels of most of those folks are very, very poor. So for innovative, interesting uses, for them to understand the value and leverage actually these products like what Max mentioned, I think education is, I think, a very, very key piece, right? For new products to be created, actually, data and disclosures actually about the risks of the products, those are also all critical. I think that will help, obviously, kind of adoption on a larger scale.
So we're sadly out of time. Could talk about this all day, but thank you so much for listening, and thank you to the panelists for joining us here today.
Thank you.